Okay, good evening. Today is, I think today is Thursday, I guess. Yeah, Thursday, 30th of October 2025. And today we will continue from where we stopped yesterday, where we'll add our building blocks towards the foundation of introducing ourselves to consolidated statement of cash flows. And yesterday we laid the foundation by trying to first of all reflect on our prior understanding of statement of cash flows for a single entity, and also on the need to present statement of cash flow. And we equally refer to the basis to which statement of cash flow is drawn, which is the cash basis of accounting, and also spoke on the thin line of the differences between the cash-based and the accrual-based, and of which the accrual-based much more produces the financial performance and position, where we're able to ascertain the profit, but there are more or less gaps between profit and cash. And though cash is king, but profit is very important for the survivor in the long future. And therefore, we try to now establish the relationship between profit and cash. And that is what brought about the indirect method of presenting our operating cash flows. Okay, thereafter, trying to revisit the fundamentals, we equally annex the basic principles that differentiate statement of cash flows from the consolidated statement of cash flow, which speaks to areas that borders on the group, where we have the parent and subsidiary, and certain adjustments are required in addition to whatever adjustment we are more or less exposed to in the statement of cash flow of a single entity. In addition to that, we also ventured into looking at adjustments that may be attributed and the impact on cash flow for investment in associates and joint ventures that were accounted for in line with IAS 28, which means by and large, we more or less delve into the consolidated statement of cash flow by combining about 3 standards all in all. Okay, IAS 7, IFRS 10, and IAS 28. Okay, which are what we combined yesterday. And yesterday we laid the principle. And if we could go back to it, let me go back to our class notes. We laid the principle where we talk about the 4 items that will always result in an adjustment and maybe cash flow impact in the consolidated statement of cash flows. And the first one, border on the non-controlling interest, is treatment with respect to obtaining dividend, the amount, and how such dividend have to be accounted for. And likewise, we look at investment in assets and joint venture, how such dividend arising from such investment is also treated, and how is even determined based on working back from the balance sheet account. And likewise, other transactions that may occur between the parent or the investor and the associates in form of financial transactions like loans or financing arrangements, or even trading that could result into intercompany balances. Likewise, we move on to the third one, where peradventure at the start of the year, we had only a parent and maybe 1 or 2 subsidiaries. And at the end, the subsidiaries has increased by 1 as a result of new acquisition during the year. The question then is, how do we reflect the impact of acquisition during the year in the consolidated statement of cash flows? Lastly, we also look at, as opposed to acquisition, there is also a possibility of disposal during the year, which means at the start of the year, we start with the parent and maybe 3 subsidiaries, and at the end of the year, we are left with a parent and 2 subsidiaries. One subsidiary has been left out of the hook by way of disposal. And the question then is the effect of that. How is that accounted for? And these are the things that we need to take into consideration. Okay? Now, looking at that, I can also now take us back to our discussion on today's lecture. Okay? Now, back to today, we will be looking at the past question for 2 nights ago, exactly a year now. That is past question, which is question 3 in the November 2024 diet examination. And I was happy with this kind of question because it's basic, simple, and straightforward. If you have to compare this with the one I provided for in the class material, you find out that this is just like a child's play, okay? But again, this is what you should likely expect, or something higher than this, a little, but not up to what I've put in that material for class, or because this is the first time you guys are exposed at skill level to consolidated statement of cash flow. But you should expect more of the one I gave you when you get to the final level, where we will be certifying you as a professional. And therefore, at that point, we'll make you the professional of repute. And at that point in time, you will be exposed to more complex situation, or because that is the final level to which you are expected to be considered a chartered accountant, as the case may be. Now, I will demand one person to please volunteer to read this question so that we can start, as time is no longer our friend. Who will volunteer at this point so that we can proceed? Who will volunteer? I need you to show up your hand. Okay, I think I saw one hand up. Adudu International. Adudu International, you can unmute.
Yes, I want to volunteer.
Okay, you can proceed. Thank you.
Okay. So, on the 1st of October 2022, Papaya PLC acquired 90% interest in Bafana Limited by... Please, can you zoom it a little? I don't know.
Okay, let me zoom it for you. Is it clear?
Okay, yes, it is. Yeah, so on the 1st of October 2022, Papaya PLC acquired 90% interest in Bafana Limited by issuing 1 million ordinary shares at an agreed value of 2 naira per share, paying 1 million naira in cash. At that time, the net asset of Bafana Limited were as follows. Assume all figures correct. Should I go to additional information?
I will want you to list. I want you to list all the items, but leave the figures so that people are familiar with the items. Yeah, thank you.
Okay. Property, plants and equipment, inventories, trade receivables, cash and cash equivalents, trade payables, The consolidated statement of financial position of Papaya Group PLC as at December 31st were as follows. Non-current assets, property, plants, and equipment, goodwill. Under the current assets, we have inventories, trade receivable, cash and cash equivalents. Then under the total assets, we have equity attributable to the owners of parent, ordinary share capital at 1 naira each, share premium account, retained earnings, non-controlling interests, total equity. I think there are some figures below that. I
There's
cannot
no
see.
figure below. Okay.
Okay.
Nothing below. Okay.
Yeah.
You
So
can
we have
continue.
current liabilities, trade payables, income tax. Then we have total equity and liability. The consolidated statement of profit or loss for the year ended 31st December 2022. Revenue, cost of sale, gross profit, administrative expenses, profit before taxation, income tax expense, profit for the year, profit attributable to the owners of Papaya PLC, non-controlling interests. Then we have the statement of changes in equity for the year ended 31st December 2022. Extract was as follows. Balance as at 31st December 2021, total profit for the year, and balance as at 31st December 2022. Additional information. All other subsidiaries are wholly owned. Depreciation charged to the consolidated statement of profit or loss amounted to 2 million naira. There was no disposal of PPE during the year. Goodwill is not impaired. Non-controlling interest is valued as proportionate basis. On the proportionate basis, required, prepare consolidated statement of cash flow for Papaya PLC for the year ended 31st December 2022 using indirect method in accordance with IAS 7 statement of cash flow. I'm done.
Okay. Thank you very much. Thank you very much. Now, what I've done is to convert that to Excel so that I can be able to work up on the Excel. Okay. I think you can see my Excel now. Okay. We can continue. Okay. Now, this is my Excel. Now, we'll start one by one by trying to make adjustments. Okay. Now, before the adjustment, what we wanted to draw is Papaya's group. We want to consider for that group the consolidated statements of cash flows. And this statement is for what period? It's at these dates. Therefore, I can build this up, all figures in thousands. And remember, I have my operating activities somewhere there. And somewhere here, because I'm using Excel, I can always amend it. I have my investing activity. And somewhere here, I have my financing activities. Okay. Now, I'll build up my working on the other side, on my right-hand side. My right-hand side will be for my workings. Working notes. Okay. That's my working notes. Now I can come back. What is my first line item? My first line item is my profit before tax. I can link that. And what's my profit before tax? That is it. Now, as you can see on the screen, next thing is for me to carry out adjustments. For non-cash items on one plate, and the other plates, non-operating items, even if they are cash-based. And as I always tell you guys, always start from the known to the unknown. Now, what are the things that are non-cash items? I can just provide a list depending on whether they are now required in this question or not, is secondary. But we know that we need to adjust for depreciation. We need to adjust for impairment loss or impairment gain. We need to adjust for increase or decrease in any form of provisions. We need to adjust for profit or loss on disposal of assets and the like. If we have interest, whether income or what expense, and whether cash-based or not, you can adjust for them because mostly they are not non-operating items. Therefore, these are the things you consider at every point in time that are non-cash items or non-operating items, and other things as the case may be. But when we look at the question we just read out, you'll find out that there's nothing that suggests impairment. This impairment loss can be even if it's on receivables, on financial assets, and even on goodwill, as the case may be. And nothing suggests any of this in the information here. And also, by the time we look at our workings, we'll see whether there might be indirect suggestion also. But when we look at additional information, depreciation is given, which means that is given a la carte, but don't expect it to be given a la carte at every point in time. Sometimes you have to look for it indirectly, and we are also going to demonstrate that today. Likewise, loss or gain on disposal of assets, you have to work for it, but in this case, they said there was no disposal of assets. And again, we need to independently determine whether goodwill is impaired or not, but the examiner has made our life easier to say, don't worry yourself, goodwill is not impaired. And therefore, all our lives have been easy. And equally, non-controlling interest was measured at proportionate share. Therefore, it means this question is just given a la carte. It then means invariably all of these items do not exist. Okay, let me just try and, for knowledge sake, let me try and strike them off. I won't delete them. And let me put them in so that you are aware in the next question. But there's none of them here. In exam, you are not expected to do what I've done. I'm only doing this for knowledge sake. Okay, just take note of that. Okay, depreciation is given to us a la carte. That's 2.1 million depreciation. Okay, let me just create a line here so that I can always pick it up. Since all figures are in thousands, I can just say 2.1 million divided by 1,000. Therefore, I can put all figure in thousands by referencing. Therefore, I can easily reference this depreciation. Depreciation has been deducted before arriving at this profit before tax. Since it's not cash item, I have to restore the profit to a position before such depreciation is deducted. Therefore, what I need to do is to add back the depreciation. Now, since there's no other item here, therefore, I need to add all of those items as an adjustment to my profit. And if that is the case, what do I have here? I have my cash flows from operations before working capital changes. And what is that? It's for me to sum these two up. And that's 4.8. You can always drop your question or show your hands up for any question. Now, the next thing is to account for my changes in working capital. So it's in this. And what are the changes in working capital? It's for me to identify what constitutes working capital. What constitutes working capital is inventory, trade receivable, cash and cash equivalent, trade payable, and income tax payable. But of these 5 items I listed, 2 of them are not going to be considered for the purpose of changes in working capital under cash flow. And what are they? I want you to put it on the chart. Of these 5 items, 2 of them are not going to be a component of changes in working capital. What are they? Put it on the chart and let me see whether some of us flowed through yesterday and even what you guys have done under the single statement of cash flows. I'm waiting for you. Yeah. I think I've seen some people. Yes, it's right. These 2 are put in yellow. Let me put them in yellow, will not be relevant for now. And why? Because 1, cash and cash equivalent are what we are working towards to establish how we arrive at it. And 2, income tax payable, we have separate section within this presentation where somewhere here we'll be showing our income tax paid or payment of income tax in that year. Therefore, we'll have to pack it out. Therefore, what we need is to look at the movement in the other 3. Inventory, trade receivable, and trade payable. But how will we look at it now? Let us come to our working. Note 1. Movements in working capital. And I'll put asterisk so that we are aware that not necessarily all working capital items may be considered. And what are the working capital items we have? I have inventory. Okay, let me do it one by one. A. I have inventory. Let me call it group inventory. Under group inventory, all figures in thousand. We look at what is the balance brought forward. Our balance brought forward for inventory, which is of 2021, was 12 million. But if you remember this concept we discussed yesterday, when we dealt with addition, and that particular example was even on inventory. We started the year with P and S1, that is parent and 1 subsidiary. But we ended the year with P, S1, and S2. The 2 are not comparable because 2 entities at the beginning, 3 entities at the end. To make them comparable, we either use the first approach where we bring in the fair value of the inventory as at the date of acquisition and adjust for it in our opening balance here before comparing it with the closing balance. Or approach 2, remove it, the fair value of the acquired inventory during that year away from the closing balance so that we can have more or less comparable basis. Either way, you are going to produce the same result as you can see here if I could enlarge it. And we'll produce the same result here, which means our group inventory at the beginning had 2 entities. Our group inventory at the end have 3 entities. Therefore, to make them comparable, we brought in by adding the fair value of the acquired subsidiaries inventory as at the date of acquisition to now make it comparable. It's at that point we look for the movement, which gave us 70. Or we remove that same 30 away from this 500 to make it comparable with the beginning. and we still get the same thing. Either way, we are going to get the same thing. And therefore, what am I going to do? I'll use the first approach, and I'll just copy this expression. And I'll come here. All things being equal, what is the addition? As at the date of acquisition, the inventory acquired was 700,000. And on that premise, I add that. And all things being equal, this is my expected value. Or let me call it expected balance at year end. Or what was my actual balance that was carried forward? My expected balance is supposed to be 12.7, but let me compare it with my actual balance. My actual balance in 2022 was 14.5. Therefore, what is the movement? It's for me to find the difference. And what is the difference? Similar to what we did yesterday, I look for the difference. Therefore, the difference, is it an increase or decrease? Therefore, it's an increase in inventory by 1.8. And an increase in inventory, what do you consider it to be? Remember the question we asked. How do we treat the movement in group inventory? First, what activity? We said operating activity. Second, is it an outflow or inflow? We said it's an outflow. Similarly, today, we are having the same thing as an increase, which is an outflow, and that constitutes outflow. Therefore, we'll come here and say increase. I remember increase constitutes an outflow. I'll put it in negative in group what? Inventory. And therefore, I link it up, and that is that. I'll replicate the same thing for my trade receivable. B, group trade receivable. Now, what is my opening balance for trade receivable? I come here. Now, trade receivable have 11,000. In the year, the value of trade receivable acquired or taken over from the subsidiary, new subsidiary acquired, was 300. Now that gave me expected balance of 11,300. And if that is the case, I'll now compare it with the actual balance. What is my actual balance? 13,700. Again, I found out that is an increase in trade receivable. An increase in trade receivable is synonymous to you lending money or giving out more money to your customer instead of collecting money from them. And therefore, that equally constitutes an outflow of cash. By how much? By 2.4. Now, we'll also do the same thing for the last but not the least. And what is the last but not the least? Is trade payable. Now, I'll copy the same thing, but change it from receivable to payables. Okay. In that case, what is my payable? Opening balance of payable was 15.2. Now, I add the fair value of the acquired subsidiary trade payable at the date of acquisition, which is this. And be careful because it's negative. I have to turn it to positive because I'm adding it to absolute number. Therefore, by the time I add it, my expected balance is 15.6. But what is my actual balance? My actual balance is 16,900. And what is it? The difference is an increase in trade payable. Now, an increase in trade payable is more or less you collecting more money from your vendor or supplier instead of you paying them, which then means you are getting more cash at the end of the day. Therefore, in that case, it's an inflow, increase in trade payable is what? An inflow. Therefore, I will add it in that case. If there's any question, right? Somebody said, sir, the figure for profit before tax is 4.2. Let us check. Profit before tax, okay, is 4.2. We wrongly linked it. And this is part of the problem when you are using Excel. You have to be careful that you are not linking to a wrong cell. We link it into profit for the year instead of profit before tax. Therefore, we can correct that. Therefore, instead of B52, it should be B50. Okay, and you can see that by just do control back, and you can see where we link it to now. Okay, I think we are clear in that manner. Okay, let me point my highlighter so that you can always see those things. Okay, that's that. Okay, thank you for that. All things being equal, what then is our total adjustment? Our total adjustment for changes in working capital is this. And what should I see? The effect of that will give me my cash generated from operating activities. Okay, in that case, what is that? It's for me to sum this and this. And since this is negative, it's going to reduce it to 3.4. Now, the next order for me is to determine my tax paid. Therefore, the question is, what is my tax paid? I'll come here and have my note 2, which means we want to determine income tax paid. In the year. And how do we determine that? Very simple. In similar fashion, given that we have graphs of our IAS 12, we start with our opening balance. Balance, brought forward. Our balance brought forward from our balance sheet is 1 million. And that's one of the reasons why we didn't consider it under working capital changes. Now, we are also aware that when we acquired, let's check, when we acquired the subsidiary, was there tax liability acquired? No. Therefore, There is no adjustment, but let me just try and put it there in case of future. Add fair value of subsidiaries acquired income tax payable. We just put nil. We put nil. I'll put 0. Okay? Therefore, there's nothing like that. I can equally strike it out. Okay? Just to expect that. Now, also in that year, was there profit? In which tax was subjected to, or was there loss in which we had a credit? What am I trying to say is that in that year, was there any income tax expense that was charged? Let us go to our income statement. Our income statement shows that we have 1.5 million charged in that year, income tax expense. But we are aware that income tax expense is made up of 2 components, current tax and deferred tax. But in our balance sheet, we have no information of deferred tax. Therefore, it means every of this income tax expense is exactly current tax because there's no deferred tax there. Therefore, the adjustment I would have made by separating current tax from deferred tax will not be required because all are my current tax. Therefore, primarily, I will add my current tax expense for the year because my current tax expense for the year should primarily increase my balance in that year owed to FRS. Therefore, my current tax in that year is 1.5. And mind the negative, the principal year is my tax payable to FRS will increase if I have additional tax in that year, which means if I've not paid my opening balance and I'm still having additional tax, my expected balance will increase from 1,000 to 2,500. I'll have to compare that with my actual balance. What is my actual balance owed to FRS from the account? It's 1.5. Okay, if it is 1.5, if it is 1.5, it means the 1,000 I owe earlier has been paid. Therefore, a decrease in my tax liability can easily be attributed to payment of tax. Is equivalent of my income tax was paid in the year. Therefore, technically, how much I paid in the year is negative $1 million. Therefore, at the end of the day, all things being equal, my net cash flows from operating activity is the sum of this. All things being equal, this represents my net cash flow from operating activities, positive cash flow. Any question on this before we go? Somebody said, sir, please, can we explain the inventory part again? I got lost, please. Now, I think you have to go back to, if you are not there yesterday, there's a general principle for group which we explain, and this is what I explained yesterday. The same principle is what affects all items that we took over from the subsidiary at acquisition. Okay, we took time to explain that principle yesterday, all because those are one of the key adjustments that separate statement of cash flows for a single entity away from that of a consolidated account. Okay. Now, also, can we have a situation where there are unsold portion and unrealized profits? There's nothing like that here because in group cash flow, we are not dealing with unrealized or realized profit. We are dealing with cash. That doesn't even come into the picture. Okay, let us take note of that. It doesn't come into the picture because what we have here are we dealing with profit and taking away all elements that are of no cash consequence, which then means that issue of unrealized or realized profits has been taken away from all of the adjustments, including the one within the working capital changes and also the one that affect profit directly. Okay, let us take note of that. Now, the next aspect is to speak to issue of the subsidiary. Now, when subsidiary is acquired, you need to determine what is your net cash investment in the subsidiary. And what does that mean? Let us look up. Note, this note 2. Note 3 is that we want to determine net cash investment or net cash paid on acquisition of a new subsidiary during the year. And what does that mean? When we acquire subsidiary, what we are interested in, what is the cash consideration? We are not interested in the entire consideration for cash flow. We are interested in what is the cash, let me put in it. What is the cash purchase consideration? Which means, like in this question, if you go back to the question, this sentence does read, and I can bolding it. It says, on October 1st, 2022, that was about 3 months to the year end, Papaya PLC acquired 90% interest in Bafana Limited by issuing 1 million ordinary shares at an agreed value of 2 naira per share, paying 1 million in cash, which means the purchase consideration was from two sources, but we are not interested in that. We are only interested in the cash. And therefore, the cash aspect of it is 1 million. But we are still going to do analysis of it. Now, let me do a short analysis for you. What is the purchase consideration? Similar to what we have done in group account, the purchase consideration here is a mix of share considerations, or what we can call share exchange, and cash consideration. The sum of the two cash consideration was easily given at 1 million, but what is our share consideration? We are going to determine that now. Now, what is the share consideration? We'll go back to the question. The question says, we acquire 90% interest in this entity by issuing 1 million shares at 2 naira. Therefore, our share consideration is number of shares offered in exchange for the acquisition is, if you go back, is 1 million ordinary shares. And the share price as at that date was 2 naira. Therefore, I'll put 1 million. Remember, all figures are in thousands. Therefore, let me put this in shares. Okay. Now, what is the market price per share at date of acquisition? We are told it's 2 naira. Therefore, okay, 2 naira. Okay. Now, therefore, what is the fair value of shares consideration? The fair value is now the 1 million multiplied by 2 naira. And therefore, that is this multiplied by this. And that gives you this in naira. Okay. Which means the total purchase consideration is this. That's 3 million. But what is relevant for us is only the cash consideration. And you'll see where this is relevant for us, the 2 million. Therefore, my cash consideration, once again, is 1 million. Now, in that cash consideration, what we're interested in is the net cash investment. Therefore, we need to deduct any cash acquired, cash or cash equivalent, acquired in the new subsidiary as at acquisition date. And let us go back to the report of acquisition. When we acquired the subsidiary, we acquired PPE of 19, we acquired inventory of 700, we acquired trade receivable of 300, we acquired cash and cash equivalent of 100. Therefore, on one hand, I gave you 1 million naira cash. On the other hand, I took over your bank account of 100, which means net, what I've given to you is 1 million minus 100, which means what I have paid you is 900. Because I gave you 1 million, I collected 100 naira back or 100,000 back. That means what I've given you invariably is 900. And that's the simple implication, which means my net investment, my net cash investment is nothing other than the negative 900. And because it's an investment, it's an outflow of cash. And that is that. Now, let's also look at our PPE. Let's look at our PPE. At the beginning is 23,000. At the end is 25. Something may suggest that if not revaluation, it means we have acquired additional PPE. But again, we took over part of the PPE of the subsidiary, new subsidiary. Let us now analyze it. Let us do the same thing we did here for PPE. Let me use the one for the income tax paid. Therefore, this note 3, let us now have note 4. Note 4 will now be cash acquisition of property, plant, and what? Equipment. What is our balance brought forward? Our balance brought forward was 23. The subsidiary brought in addition. The subsidiary brought in addition of 19, which means that will have increased further the 23 by 1.9. Now, during the year, was there depreciation? And if there's depreciation, we'll have deducted depreciation. If there's also impairment, we'll have deducted impairment. If there's revaluation, we'll have added revaluation. And I'll put all those things there. We deduct revaluation, impairment, loss. If there's revaluation, you'll have added revaluation gains and etc. But these other two did not exist. Therefore, I'll strike them out and put 0, 0. And I did that just for the purpose of our knowledge. Okay, let me put them in red. But depreciation, remember we have depreciation, which we have to deduct. Our depreciation amount then that was given a la carte was 2.1. Therefore, I have to deduct it. All of these, let me add them together. Give me these amounts. Therefore, what do? I sum them up to arrive at my expected balance of 22,800. And I can now compare 22,800 with my actual balance of 25. And what is the difference? 22,800 minus 25 gave me a difference of 2.2 million. Therefore, this difference, which means an increase, shows that there's an addition in my group PPE. And that is tantamount to cash purchase of additional items of PPE in that year. Therefore, let me just remove the additional. And therefore, this constitutes an outflow of cash. Therefore, payments on purchase of property, plant, and equipment. Now, we don't have any other assets like intangible, like investments. Therefore, this may constitute our final information within investing activities, which means net, my net cash flow used by investing activity or consumed by investing activity will be sum of these two, and that is 3.1. Whereas here, the net cash flow generated from operating activity is 3.1. Okay. If there's any question at this point, let us know before we move to the final activity. Okay? Any question? Sir, please, how do we find cash paid on the purchase of subsidiary if it was not given? If it was not given, therefore, they will give you information about the purchase consideration, such as here, they gave us number of shares and the share price. Instead of now giving us cash, 1 million, they might say a cash of 80 kobo was paid for every shares acquired in the subsidiary. What they do now to do is to find what is the total number of shares of the subsidiary, find 90% of it to determine the acquired shares by the parent, and multiply by 80 kobo, which is the cash you are supposed to pay, and you get the 1 million, hypothetically. Okay? And this speaks back to your fundamental understanding of group account, and go back to various purchase considerations applicable. Is it cash considerations? Is it share consideration? Is it debt consideration? Is it asset transfer as a consideration and the like? Okay, another question is, so depreciation, a non-cash item is used to arrive at addition. Yes, now, what is addition? If you have not added to your PPE during the year, the old math will give here to give us our expected value to equal our actual. But when there's no, when your actual is now more, means that you have purchased more item of property, plant, and equipment. If not, it should give you the same thing now. You understand? And if the actual is less, it means you have disposed of part of your item of property, plant, and equipment. Go back to your fundamental principles of IAS 16. Okay. Yes, you said your emphasis on depreciation is the same thing now, because your depreciation will reduce the kind amount of your PPE to what is supposed to be at the end of the year. And when you now compare it with what you have at the end of the year, and that is higher, it means something has happened. And what are likely to have happened is acquisition or purchase of additional PPE if you have not committed error. That's just a common principle. Is that okay? That principle, before now, you've added under IAS 16. That same principle, you've added under IAS 7, where you discussed on statement of cash flow for purely a single entity. Please let's go back to those fundamental principles. And if you still need more understanding about it, you could go on my YouTube page where I delineated IAS 16, part 1 and part 2, so that you know that IAS 16 goes beyond just cost, depreciation, and the likes. There are critical things there. Somebody said, please, under examination condition, can you use T account to express your working? You can use T account, but T account is just mainly showing that many people cram by understanding, okay, you put it here, you put it at the left, you put it at the right. No, what matter is the real understanding, because in real life, there's no T account anywhere. All your ledgers and the likes are more or less presented vertically. And apart from that, vertical explain things by way of, is it bringing about increase in the element of financial statements, be it an asset, liability, income, or what, or is it bringing about decrease? And that is the fundamental principle that we need to appreciate beyond whether it is T or no T. But for exam, you will not be penalized because it's a working. You can work things out the way you want. The only thing you will be penalized for is your order of presentation, which means you must follow this order of presentation. But anything working, you can do it anyhow. You better understand. Now, finally, there was issue of shares. Now, look at it. Our share capital increased from 10 to 11,500. Therefore, let us see what may have happened in that situation. Okay, it increased by 1.5. Okay, and our share premium increased by 1.5 also. What could have happened? Now, let us go to working note 5. Working note 5. Let us try and look at cash proceeds on issue of shares. Now, we have two categories of items: share capital and we have share premium. All figure in thousands. Now, what is the opening balance? Opening balance of our share capital was 10,000, and opening balance of our share premium was 5,000. Now, remember, our balance at the end for share capital was 11.5. Our balance at the end for share premium is 6.5. Now let us look for the difference. We had increase in share capital and premium. How do I know? At the end, for share capital, 11.5 is greater than 10 million. By how much? 1.5 million. Similarly, for share premium. Now, the question is, can we attribute this to increase arising from issue of shares on acquisition of the subsidiary? Remember, when we acquire subsidiary, we are told that Papaya acquired 90% interest in Bafana by issuing 1 million shares at 2 naira. And if you go back here, the share capital is 1 naira each. It means he issued it at 2 naira, which is at a premium. And if you come back here, remember that we determine here, I'll highlight it in yellow, that there's a share exchange that occurred where the parent have to give 1 million of his shares plus cash to take over the shares of subsidiary. Now, in that case, this 2 million naira can be attributed to the nominal value of issued shares on acquisition of subsidiary. And what it means is 1 naira multiplied by that 1 million shares gave us increment of 1 million. And that gives us 1 million. Also, premium on issue of shares and the premium is 1 naira or 2 naira minus 1 naira will give us 1 naira. Therefore, let me put naira in front. Okay. And that same, it will be 1 naira the same 1 naira again, which is the premium, comes to the same amount here. Now, the question then is, once I remove this, what is left? Which means I've already accounted for 1,000 out of 1.5. And again, on this one, you have accounted for 1,000 out of 1.5. What is left? Is amount that can be attributed to issue of shares for cash at the end of the year, which means what is left is cash proceeds from issue of shares, maybe to the public. And in that case, I can have 500 and also 500. Okay, therefore, I can easily come here. Proceed on issue of shares. That is 500. Note 5. 500 plus 500. And I can put it in Naira. And that gives me my 1,000. Or you split it, as the case may be. Now, we have non-controlling interest. Remember, we discussed about non-controlling interest yesterday. I think that's even the first or second thing we discussed. Yeah, the first. The principle applied. We want to determine what was the dividend paid out to NCI, if any, in that year. And that speaks to the fact that, similar to what we did yesterday, I can bring the same thing out and use it here, which will be probably my last note, note 6. Note 6. We want to determine the amount of dividend paid to non-controlling interest. And in this case, we have no balance of dividend payable. Therefore, I'll take those ones out. Or let me leave it here. I'll just cancel it out. It was 0, and this one is 0. Now, what is my balance brought forward for share of net asset or equity of NCI? At the beginning, NCI was 0. At the end, NCI is 310. Therefore, I'll link it. NCI was 0 at the beginning, and NCI is now 310 at the end. Now, these two, I'm going to cancel them out. Okay, or because they don't exist. Now, what is the share of profit to NCI? The share of profit to NCI, we see it in our income statement where we attribute the profit. Now you can see profit attributable to NCI was 90 out of 700. Therefore, I linked it. Therefore, my expected balance for NCI supposed to be 90. Okay? But remember, there was addition added at acquisition of NCI. That means we've not considered one item here. Because the subsidiary was just acquired, we've not considered what is the value of NCI when we brought in a new subsidiary. Therefore, I need to do that beneath. Added on acquisition. Therefore, I need to determine the net asset as at the point of acquisition. Remember, the examiner said we adopt proportionate what? Share of identifiable net worth assets of the subsidiary as at date of what? Acquisition. Therefore, what is that? I needed the share capital. I needed the share capital. What is the share capital of the subsidiary? And I needed the pre-acquisition reserve. But because I was not giving the exact balance sheet of the subsidiary, but I was giving its assets and liabilities at acquisition. These are all its assets, and these are its liabilities at acquisition. Therefore, I was giving the net asset. And remember, net asset is equivalent of equity. Therefore, this is the equity of the subsidiary at acquisition, 26. I'll bring it here. Equity or net assets of the new subsidiary at date of what? Acquisition. Therefore, if that is 26, if it is 26, what is the proportionate share? Percentage stake of NCI. Now, remember, we are told that we acquire 90%. Therefore, NCI stake will be 100% minus 90%. And that will give us 10%. The question then is, the proportionate share NCI value at acquisition is 10% of 2.6 million. And that is what? And that's 260. All things being equal. It is this 260 that will bring here as added on what? Acquisition. It then means all things being equal. If dividend has not been paid to NCI, our total balance should be 350. But what we have is 340. It then means the difference, which represents a reduction, is as a result of dividend paid out to NCI, which is 40. Therefore, remember, this one came from Let me highlight it. It came from here. All being equal, I can come here. Dividend paid to non-controlling interest. Remember the asset of other shareholders. Which is an outflow of cash, is 40 negative. Therefore, all things being equal, what is my net cash flow used or generated from financing activity is what you can see on your screen, which is what? 960. All things being equal, what is our increase or decrease in cash in that year? Increase or decrease in cash in that year is the sum of our net cash flow of 2.4 positive in operating activity minus 3.1 negative in investing activity and plus 960 positive in that. And that gave us what? 60, as the case may be. Now, what then do? We then bring in our cash and cash equivalents. Brought forward, or as at the beginning of the year. And we use it to determine our cash and cash equivalents at the end of the year. And what do? I'm going to create a statement. I'll call it cash and cash equivalents. For the year, I'll put the date, 31st December 2022, represented by now 2022, 2021. All figure in what? In 1,000. I'll bring in my cash and bank. I'll bring in my other short-term marketable security that qualify as cash equivalents, which you have been explained to and clarity provided with respect to very short-term liquid instruments like treasury bills, usually of less than 3 months. And I'll bring in my bank overdraft. For the purpose of statement of cash flow, you are expected to offset your bank overdraft, which you don't do for balance sheet. Therefore, all of these are things I'm going to put together. The difference is that I will subtract bank overdraft, while I will add cash and bank with other short-term marketable security. But in this case, I don't have these two. Therefore, I'm going to strike them off. And I'm left with my cash and bank. At the end of the year, my cash and cash equivalent was 760. At the beginning of the year, my cash and cash equivalent was 500. Now, what I just need to do is to link my brought forward from my statement, and it must produce the same thing I have in my statement for carry forward. And this 760 must equal this 760. That is what you use to prove that you are able to explain to the nearest naira how you are able to generate 760 away from 500 at the beginning of the year. And that is just the position, as the case may be. Any question? Any question? Okay. Any question at this point? Any question? Which means we have successfully, more or less, produced consolidated statement of cash flow. Somebody said, last talking, where did we get 90? We got 90 from the question. On October 1st, 2022, Papaya PLC acquired 90% interest in Bafana, and that is how we're able to determine that NCI is 10%. Okay, and remember, from the additional information, we were told that NCI, which are put in yellow, NCI is valued on the proportionate basis. And that is that. Any question? Any other questions? In the absence of no question, we've come to the end of the consolidated statements of cash flow. Thank you very much once again, and God bless you all. You will get the Excel sheet as usual. If you have followed me through, you'll get it on your WhatsApp. And also, the sheet may be hosted on the YouTube also. Thank you very much, and God bless you.